Hello, everybody. I want to, in my own little sketch here, help reinforce the knowledge of debit and credit in recording transactions. So you just have to commit this to memory. You know about the balancing of the equation, that the left side represents the assets and the right side represents the equities to those assets. And I didn't put my plus sign in there, but you know that A equals L plus OE. Now, this is the left side, that's the right side of the equation, and the double entry bookkeeping requires that when you record a transaction, it has to be recorded in such a way that at least two accounts are affected in recording the transactions. And after recording the transaction, the accounting equation always has to balance. That proves accuracy in accounting, for the most part. You have to commit these rules to memory, so that if you look at any account or accounts, I could have added cash, accounts receivable, and so on. But the left side, the asset side, all asset accounts are increased with debits and decreased with credits. The opposite side, the main three elements, the other three elements, the other two apply to liability accounts, such as accounts payable, notes payable, salaries payable, and the owner's equity account, which we call usually in the name of the owner. Now, what's unique to the owner's account, and in virtually all accounting systems today, we have to create separate accounts for the items that have impact on owner's equity. That's why I created this little house here, the house of capital. Now, in Chapter 1, you learned that if you had a revenue, you'd come over, if you earned it right away, you would debit, or you would put a plus sign under cash, and you would put a plus sign under revenue, under capital directly. But what we've done here is we've broken all the accounts down into two sides, the debit and credit side, so that instead of putting plus, 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 minus, and so on, we have debits and credits to record those pluses and minuses. So that if I had that revenue, instead of adding it directly to capital, which eventually the capital account is affected, more revenue is more capital. But so that we debit cash or accounts receivable when we sell our services, and we come over here, not in the capital account, but outside, we credit the revenue account. So if we have a debit and a credit, it's going to balance, and the equation will balance. And ultimately, that credit will have that plus here will have a positive impact. Likewise, that when we have the negative items that impact capital as such, we normally would put minus, or back in Chapter 1, I should say, would have a minus to the capital for a withdrawal of the owner or an expense that's incurred. So we have pluses here to accumulate the amount of withdrawals, so that if the guy took out $100 a month, you'd have 4 debits in here, and it would tally up to 400. So that the plus sign simply means accumulate. Same thing with expenses. You'd have many different expense accounts, and every time you debit expense, for example, or withdrawals, you would debit the withdrawals. If you pay in cash, you'd credit cash. If you incurred a salary expense, you debit salary expense and credit cash. So what happens is these debits are used in place of debiting capital directly, but rather at the end of the accounting period, these withdrawals and expenses and the revenues are summarized, and then the positive effect of revenues minus the negative effect of withdrawals and expenses are finally transferred as negative items in the capital account. So the concepts don't change. A revenue adds, a withdrawal and an expense deducts. These are simply accumulators of negative items. These pluses simply mean we are accumulating, adding the negative stuff, and then at the end of the period we take the positive stuff minus the negative stuff, and we transfer. If it's positive, we add. If it's negative, we subtract. So your rules are, on the left side, you debit assets to increase, credit them to decrease. With that arrow moving to the left, representing the left side of the equation, and you can see the arrow up. With the arrow moving to the right, you see the assets going down. And I did a similar illustration over here. With the arrow moving to the left, with respect to liabilities and capital, you see the negative with the debit, and you see the positive with the credit. So you just have to commit these rules to memory. Debit, credit. Buy an asset on account, debit, credit. Buy an asset for cash, debit, credit. Debits and credits are equal. Pay off a liability, debit, credit. Buy something on credit, debit whatever you buy, credit accounts payable. Make an investment in the company, debit if it's cash, debit cash, credit the capital account. If you earn a revenue, debit either cash or accounts receivable, credit revenue. If you pay off the liability, debit liability, credit assets. If you make a withdrawal, debit withdrawal, credit assets. Debits and credits must always be equal. And then when you're done recording, you prepare your trial balance. Okay? So the only time you would reduce withdrawals is if you made an error or you put some money back in or whatever. And the same thing with expenses. And of course they get closed out at the end of the accounting period in the closing process, which you won't see until the end of chapter 5, I believe. Now down here I did a couple of A, B, C, D, right? I started to do D. So I give you 3 transactions. So the owner invests, let's say, at 10 grand in cash. What's the rule? What 2 accounts are there? Cash and capital. What way are they going? They're both going up. So how do you add to an asset, which you've defined? You know that you've classified cash as an asset, and the owner's equity in the name of the owner is a capital account. So you got 2 accounts going up. You debit one side and credit the other, and that takes care of that particular transaction. Debits and credits are equal, and the accounting equation, if you were to balance it, you can see left and right would be equal. In the second one, I simply shifted $2,000 into equipment. I bought a piece of equipment for $2,000. What accounts do we have? Equipment and cash. One's going up, one's going down. How do you achieve an increase in equipment? With a debit. How do you achieve a decrease in cash? With a credit. So the cash balance now would be $8,000, 10 minus 2. And then in the third one, I had you buy a piece of equipment on credit to show you that it's not a shift in assets, but the $1,000 came from the purchase on account. Therefore, we debit equipment and credit accounts payable. I was going to go further and illustrate some other types of transactions, but I'll save that for now. But hang on to this video. I think you could do a screenshot in the upper right-hand corner of your screen where it says Print Screen System RQ. If you press that, then open up a Word document. You can copy this sheet, okay, onto your own sheet and print it out and stick it in your book. Keep it handy. Okay, I'm going to try to stop this somehow. I have to get to my